Assalamu alaikum friends, welcome to today's standard. Today's standard is IAS 41. Before I start, I want to tell that there's a syllabus change in IAS 41. The syllabus change is that this was like any other standard. This was a specialized area of what we need to know. For example, like IFRS 9 or IAS 12 and all. This was one of it. Like you had to know IAS 41 in SBR. But now what happened is this is removed from your SBR. It will not be asked as a specialized area, this IAS 41. But the reason I'm still uploading this one is that this is still in the financial reporting syllabus. So because whatever is there in your financial reporting, it is an assumed knowledge for your SBR. That means you should know about it. So that's why I'm giving it from that perspective. Okay, but in SBR, it's not there anymore. It's removed. This is the syllabus change from September 2021 onwards. So because wherever your syllabus changed, most of the people was asking me this doubt whether I have the latest textbook or the revision kit from the September. It's not there. I don't think many of us received it. So I don't have it. What I have, the latest is June 2021, up to that we can use for your September exam. But the thing is, there are some areas which is not there anymore, and some areas which might be asked. They are combined into some other area. Like two areas might be combined into one, and some areas are deleted, and some areas they have amended somewhere. Like IS 41, it's not there. So wherever the changes occurs, I will tell you for that standard only. Because the syllabus didn't widely change, so you don't have to panic. It is still the same syllabus, still same things. Only a few areas changed. The changes are in IS 24 related parties and IS 19 employee benefit and this IS 41. The rest all is relating to your sustainability reporting, all those things. But there's definitely I will go through it later. So these are the few, I think 3 or 4 standards where changes are very small, not big major changes are not there. So you still can use the June 2021 textbook for your September exam. Inshallah by December exam, for the December exam, inshallah I think by September we'll get the textbooks and the revision kit. So that was an announcement which I wanted to make. So let us start with IS 41. IS 41 is like an asset, agriculture. Okay, so IS 41 says agriculture applies to biological assets and to agricultural produce at the point of harvest. So you need to know what is this term. One is biological asset, the other one is agricultural. At which point harvest? You need to recognize this as an asset. What is the definition of biological asset and agricultural produce? Biological asset. So I will be going a little fast here since this is not so important from SBS point of view, but it is an assumed knowledge for financial reporting. Okay. A biological asset is a living plant or an animal. And agricultural produce is the harvested product of the entity's biological assets. That means harvested product of the living plant and animal. Biological asset means this, right? This is the definition. Harvest. Harvest is the detachment of produce from a biological asset or the cessation of a biological asset's life process. Okay. The produce is separate from biological asset. The detachment. That is known as harvest. Okay. Application of the definitions. You need to know that whether it is a biological asset or an agricultural produce. So this is some definition. A farmer buys a dairy calf. That calf is a biological asset, right? Because the calf is a living animal. The calf grows into a mature cow. So growth is the type of a biological transformation, right? Growth. The farmer milks the cow. The milk has been harvested. Milk is agricultural produce. You cannot say milk is a biological asset. It's not a living plant or an animal. It is an agricultural produce because milk has been harvested. Now let us go to the biological assets in depth, how to recognize. The recognition criteria for biological asset. A biological asset should be recognized if, see, a biological asset, it follows the properties of asset only. So these were the same 3 definitions which we used for assets when we had to recognize under IAS 16. First is there should be a probability that future economic benefits will flow to the entity from the asset. That means you should receive the benefit from having that asset. If you're not receiving any cash inflow from having that cow or milk in your farm, what's the you cannot recognize an asset. The cost of fair value of the asset can be reliably measured. You have to measure the cost or the fair value if you're using fair value. Entity controls the asset. A farmer should control the cow he have is in a farm. Okay. Initial recognition. How do you initially recognition and how do you measure it subsequently? So initial recognition is biological assets are initially measured at fair value less estimated cost to sell. So this is what you need to remember. It is fair value less estimated cost to sell. Gain and losses may arise in profit or loss when a biological asset is first recognized. Right? First recognize, you will have some gain or loss. And this is recognizing profit or loss. For example, a loss can arise because estimated selling costs are deducted from fair value. You understand? Maybe the selling cost is more than the fair value. Then it's a loss. And gain may arise when a new biological asset, such as lamb or calf, is born. It's a gain, right? When you're having new biological asset, let's say you have a cow. That cow is giving born to his kid, the calf. So it's a gain for you because now you have a new additional biological asset. Okay, what is the subsequent measurement? At each reporting date, the biological assets are revalued to fair value less cost to sell. Again, they are revalued to fair value less cost to sell. Initially also they were valued at fair value less estimated cost to sell. Here it is fair value less cost to sell. Even subsequent measurement. So gain or losses arises from changes in fair value are recognized in profit and loss. Same. Definitely when your fair value changes, that gain or loss due to fair value is recognized in profit and loss. See, in every standard, you need to know where the gain and losses goes. And some standards, it goes to other comprehensive income. Sometimes it goes to other comprehensive income and it is reclassified to profit and loss account. Sometimes it goes to other comprehensive income and it cannot be reclassified to profit and loss account. Sometimes it just goes to profit and loss account. So there are 4 scenarios. Okay, so here it's very easy, profit and loss. You don't have to worry about other comprehensive income. IAS 41 is pretty small and easy standard. The fair value of a biological asset may change because of its age or because the prices in the market have changed. IAS 41 recommends separate disclosure of physical and price changes because this information is likely to be of interest to the users of the financial statements. However, this is not mandatory. They recommend that there should be a separate disclosure of physical and the price changes because they think this information might be useful for the users of it, even though this is not mandatory. Okay, maybe this lecture might not be so helpful for the SBR students, but definitely this will be helpful for the financial reporting students if you're watching this, right? But I don't leave anything, right? Because even though there are very small chances of this coming, it's an assumed knowledge. Assumed knowledge might come. They never told that financial reporting knowledge might not be tested in SBR. They might come. Biological assets are presented separately on the face of the statement of financial position under non-current asset. Okay. So biological assets are under non-current assets. Inability to measure fair value. What if you cannot measure the fair value? It's hard to measure the fair value of your cows and your lambs and all those things, right? So presume that the fair value of biological asset will be capable of being measured reliably. See, we always assume it's a pre-assumption that we'll get the fair value. It is we can measure it reliably. But if the market prices are not readily available, let's say you don't know the market price of your cow, okay, the same cow and with the same breed, then the biological asset should be measured at what? Cost less accumulated depreciation, because it's an asset, so cost less accumulated depreciation and accumulated impairment also, impairment losses. Then it is taken at cost. Once the fair value assets can be measured reliably, it should be remeasured to fair value less cost to sell. See, once you know fair value is there, then you cannot use cost. Then you have to use this old, the initial method, fair value less cost to sell. Okay. So we'll definitely do question. There are 2 questions on it. We'll do it at the end. Agricultural produce. At the date of harvest, agricultural produce. So now we are moving towards agricultural produce, guys. Biological asset is over. At the date of harvest, agricultural produce should be recognized and measured at fair value less estimated cost to sell. So here also is same, like biological, this one, fair value less cost to sell. Gain and losses and initial recognition including profit and loss, operating profit for the year. Same like biological asset. It is following the same thing. Gain or loss in the profit and loss. That also in the initial recognition. Usually what happens, gain and loss, we get it in the subsequent measurement, not in the initial recognition, but here they are. After produce has been harvested, it becomes an item of inventory, remember. After the produce has been harvested, it becomes an item of inventory. Therefore, IAS 41 ceases to apply. You cannot use IAS 41 anymore from that point onwards. Then what happens? Then you have to use IAS 2 because it's an inventory. So the initial measurement point at the point of harvest is the deemed cost for the purpose of IAS 2. You see the deemed cost because you need it for IAS 2. That is the initial measurement value at the point of harvest. Okay, which is applied from then onwards. Then you apply from the IAS 2 rules. Assets outside the scope of IAS 41. You definitely should know this. IAS 41 does not apply to intangible assets such as production quotas, bearer plants, or to land relating to agricultural activity. If there is a land which relates to agricultural activity, that is also not taken under IAS 41. No. So no intangible asset, okay? Does not apply to intangible assets also. Such as what is the production quotas, if you have any, that is IAS 41 does not apply there. Bearer plants, okay? So make sure that you Google and check what is this bearer plants, okay? If you want to know the meaning of it. In accordance with IAS 38, intangible assets are measured at cost less amortization or fair value less amortization. What if it's an intangible asset? Then not IAS 41, then it is IAS 38 you apply. Okay, and intangible assets are measured at cost less amortization or fair value less amortization. It depends on which method you choose, cost model or the fair value model. But amortization you have to deduct under both the methods. Bearer plants are used to produce agricultural produce for more than one period. Examples include grapevines or tea bushes. So bearer plants are accounted for in accordance with IAS 16. That's why it's not under IAS 41. However, any unharvested you can use it IAS 41, okay? And has unharvested produce growing on a bearer plant such as grapes on a grapevine. It is a biological asset. And so it is accounted for in accordance with IAS 41. Land is not a biological asset. That's why it is treated as a tangible non-current asset. That's why IAS 16. So when valuing a forest, for example, the trees must be accounted for separately from the land that they grow on. You see, you don't take the forest together. In the forest, you have two things. One is land, one is the trees. Trees are valued separately, land is valued separately. Because land is not a biological asset. Even the trees are biological assets. So trees you deal under IAS 41, the land you deal under IAS 16. Now we have agriculture and government grants. We finished government grants, which is IAS 20, right? So because sometimes government can give you grants to it relating to biological assets. So if government grants relates to a biological asset measured at its cost less accumulated depreciation and accumulated impairment losses. Biological asset measured at its cost, not fair value minus selling cost. Okay. It is accounted under IAS 20. Then you cannot say it is IAS 41. If government grant relates to biological assets measured at fair value less cost to sell, then it is accounted for IAS 41. So there's a difference. If it is measured at cost, IAS 20. If it is measured at fair value, IAS 41. Fair value less cost to sell. So you have to see the government grant relates to what. Now there are two things. One is known as unconditional government grant, the other one is conditional government grant. Unconditional government grant relates to biological asset. Measured at its fair value less cost to sell shall be recognized in profit and loss when it becomes receivable. Okay. So if it is measured at fair value less cost to sell, this shall be recognized where? In profit or loss when it becomes receivable. Right? This is for unconditional government grant. What if it's conditional? That means it is based on some conditions the government will give you grant. Related to biological asset measured at fair value less cost to sell shall be recognized in profit and loss. Same. Profit and loss only it has to be recognized, but the time period changes when the conditions attaching to the government grants are met. So if it's not conditional, Whenever it becomes receivable, you recognize it in profit and loss. But when it's a conditional, until the conditions are met, you cannot recognize it in profit and loss. So conditions attaching to the garment grant are met, you recognize. Now let us go to the disclosure. So so next is inventory. We have finished IS2 is there. IS 41 says that an entity must disclose three things: description of each group of biological assets, methods and significant assumptions used when determining fair value, reconciliation of the carrying amount of biological assets between the beginning and the end of the reporting period. So these are the three uh, disclosure. Now let us do the two test your understanding before I go to the next standard. Test your understanding 1. So this is about cows. On 1st of January 2001, a farmer had a herd of 100 cows, all of which are 2 years old. At this date, the fair value less point of sale cost of herd was 10,000. On 1st of July 2001, the farmer purchased 20 cows, each 2.5 years old, for 60 each. As of 31st December 2001, 3-year-old cows sell at market for 90 each. Market auctioneers have charged a sales levy of 2% for many years. Discuss the accounting treatment of the above in the financial statements for the year end of 31st December 2001. Okay, so if you see the answers, first you need to recognize the cows. What are they? They are biological assets and should be initially measured at fair value less cost to sell. So now you're going to initially measure it. The cow purchased in the year should be initially recognized at what? At this 1176. How? 20 into 60 into 88, 98%. Remember, this is 98% because sales, there has been a sales levy of 2%, and 20 into 60 because you have purchased 20 and each will be for 60. So 20 into 60. So this will give rise to an immediate loss of 24. How? So you have initially purchased the cow at this cost 1176. So 20 into 60 you minus the cost 20 into 60 because 20 cows at 60 and now you minus this cost 1176. In the statement of profit and loss, it's a loss. Cost is more than what you have bought it for. At the year end, the whole herd should be revalued to fair value less cost to sell. Any gain or loss will be recorded in statement of profit and loss. The herd of the cows will be held at this one 120 into 90. That means 10584. You see, it is 90. Okay. Why 120? Because 100 you have in the beginning and then you purchase another 20. So in the end, you will be having 120 into 90. Again 98% because sales levy is 2%. Okay. This will go in the statement of the financial position. This will give rise to a further loss in the profit and loss. Let us see that loss. How? What is the value in the beginning? They told it was 10,000. Fair value less cost. New purchase was this. This is the cost. Now, this was the loss because it's a balance figure. This has to be the closing balance. So the balance figure is the loss. Understanding? Now let us go to test understanding 2. Good Vine is a company that grows and harvests grapes. Grapevines which produce a new harvest of grapes each year are typically replaced every 30 years. Harvested grapes are sold to wine producers with regards to property, plant and equipment. Good Vine accounts for land using the revaluation model and all other class of assets using the cost model. On 30th June 2001, its grapevine had a carrying amount of 300,000 and remaining useful life 20 years. The grape on the vines which are generally harvested in August each year had a fair value 500,000. The land using for growing the grapevine had a fair value of 2 million. This is for growing the grapevine, the land. Now, on 30th June 2002, grapes with a fair value of 100,000 were harvested early due to unusual weather conditions. The grapes left on the grapevine had a fair value of 520,000. The land had a fair value of 2.1 million. All selling costs are negligible and should be ignored. Discuss the accounting treatment of the above in the financial statements for the year end 30th June 2002. There are so many things you need to measure. One is the land, one is the grapes, one is the grapevine. Grapes that are left on the grapevine. You need to recognize what type of goods they are. Are they biological asset? Are they agricultural produce? So you need to write it because accordingly you will deal with each, right? So land is the easiest. Land is accounted under IAS 16. It is not a biological asset. So if and they have told the revaluation is chosen for one, but others it is cost. So the revaluation model is chosen. Gains will go in the other comprehensive income. Gains in the fair value of the land. At 30th June 2002, the land should be revalued at 2.1 million, and there will be a gain of 100,000 which will go in the other comprehensive income, and this will be held within a revaluation reserve in equity. Let us see. If you see the land here, let me highlight it for you. Land had a fair value. This is a closing, but what was its initially the value of the land? Uh, it was here 2 million. You see. So 2 from 2 it increased to 2.1. So there's a gain of 100,000. This will go in other comprehensive income. Now let us go to the grapevine. Grapevines are used to produce agricultural produce over many periods. So now they are talking about the grapevines. This means that they are beer plants, okay? Because they are used to produce agricultural produce means they are beer plants, and beer plants are not dealt under IAS 41. Therefore, they will be accounted under IAS 16. So except for the land, because land is also under IAS 16, that is also under IAS 16. But remember, except the land, because for land they have used the revaluation model. Goodwine uses the cost model. They use cost model for other property, plant, and equipment. That means for this grapevine you have to use cost model. So therefore you have to charge depreciation. Okay, depreciation they told useful life is 20 years, and what is it will be 300,000 divided by 20 years. They'll be charging profit and loss, the depreciation, and then the grapevine will have a carrying amount of this much. You deduct the depreciation 15,000 from the 300,000, the cost at this date. Let us go to that 300. If you see here, useful life is 20 years and 300,000. This is the carrying amount, right? For the grapevine. Now, let us go to the grapes growing on the vines. Grapes that are growing on the vines are biological assets. They should be revalued at the year end to fair value less cost to sell with any gain or loss. Gain or loss will be reported in P&L. Their biological assets should therefore be revalued to 520,000. Okay, there will be a gain of 20,000 because from 500 it increased to 520. It should be reported in profit and loss. We'll check to see the value. You see here. You see it had a value of 500,000. The grape that were growing on the vine, now it has increased to 520,000. So it's a gain. What about the grapes? Just the grapes. They are agricultural produce, and this also should be measured at fair value less cost to sell. Any gain or loss, profit or loss. So initially they are measured at recognized at 100 with a gain of 100,000 reported in profit and loss. The harvested grapes are now accounted. The harvested grapes, once it is harvested, they are now accounted in accordance with IS2 at a deemed cost of 100,000. So that whatever you have recognized initially, that now becomes a deemed cost. And from there onwards, you will apply IS2. Okay, let's check for the grapes. You see, the grapes had a fair value of 100,000. So that's it for IAS 41, and see you in the next standard.